Let's get to those top picks. First idea, Tamarack Valley.
Yeah, so Tamarack's been very, very active this year, aggregating acreage in the Clearwater, which we've talked about several times, the most economic play in North America. And so by doing so many deals, it's created a stock overhang. The stock's been kind of a crummy performer so far this year. I think that changes next year because they've amassed enough acreage so that they do not have to do any more M&A. And so now they can be focused on using the free cash flow, paying down debt, and getting closer and closer to being able to reach that inflection point to pay us more of that free cash flow. We've got them paying us about 50% of the free cash flow next year. Stock's trading at 2.6 times cash flow and a 32% free cash flow yield, which we have the North American average about 3.2. So I'm paying a discount to the North American average for a company that has amassed their primary play that's the most economic. And so it just shows you just how unbelievably inefficient this market is. We put about a 5 multiple on that. We're getting about 120% upside potentially next year if we're correct on $100 oil.
Baytex Energy.
Yeah, I find this one has just completely fallen off the radar screens. There's a new CEO. I think I'm having dinner with him in a week or two. So we've only chatted on the phone. I liked the conversation and their focus on, again, continuing to implement the plan of paying down debt, getting closer to that inflection point to return more and more free cash flow back to us. These guys have drilled 15 of the top 15 wells in the Clearwater, which again is the most economic play in North America. And yet we've got this company trading at 2 times cash flow and a 37% free cash flow yield. So they reach the inflection point about Q3 of next year, where they've pledged to give us 75% of that. I would be a proponent of them being very aggressive on share buybacks, and that's true of the sector. So when you can buy the best guy in the best play in North America at a material discount to average, where you've got ongoing delineation and exploration results coming up, and you can see line of sight to getting paid 75% of that free cash flow, to me, that really excites me. So we put a 12% free cash flow yield target on it. We're getting 170% potential upside. And again, that's at $100 oil.
Your final idea here, Meg Energy.
Yeah, we've talked about Meg a whole bunch. Like it's a pure play oil sand company where they're paying down debt. This time next year, they'll reach their final leverage target, at which point they'll be giving us 100% of their free cash flow. The stock's trading at a 27% free cash flow yield. That's at $100 oil. And so I view it as I've got 35 years of production. I'm paying for roughly 3 of them, 3 to 4. So I'm getting at least 30 years of reserves, i.e. free cash flow for free, where they've committed to return all of that back to shareholders, and that will drive, in my opinion, the re-rating. So stock's done very well. We still see about a double in the stock price using $15 differentials and $100 oil.
And Eric, did you say that they have tax losses that an acquisitor could use?
Massive tax losses as well. Scotia, this is about a year-old analysis, but it would still be relevant. They ascribe value of about $4 to $5 per share in Meg just for those tax losses, which tells you how much, the prior management, but this company was not the best steward of capital. This is going back 15 years, so it's not Derek Evans and the existing team. And we ascribe zero value for the tax assets, so that's just gravy that ultimately I would be highly surprised if this company's around for more than a year and a half. But I'm not buying it for that. I'm buying it because it's, in my opinion, profoundly mispriced.
And Husky was going to buy it.
Totally.
And walked away from the deal ultimately.
And then they got bought.
Yeah, they got bought. Okay. We still got a bit of time. Let's do another market called Mini Minute. Freehold Royalties, Eric.
We like Freehold. We own it in our main fund. It's paying a yield of about 6.4%, at a 45% payout at $100 oil. We think they could increase distributions by about 50% next year. They whiffed on Q2 results. Stock got penalized. I'm pretty confident they're going to have a good Q3, and they could get re-rated from that.
What was wrong with the Q2?
It was just volume slippage. They did an acquisition, and the barrels didn't come on as quick, but it's stupid, right? Like, oh my God, they come on a week later. Oh, geez, let's sell off the stock. It's really dumb. So we tried to take advantage of other people's stupidity.
Petrobras.
We've looked at this one. So what's glaringly obvious is right now they're paying about a 35% dividend. However, the new president of Brazil is instilling a new CEO that is going to be reevaluating the strategy. And so there's profound uncertainty as to whether that dividend gets cut. We looked at it from the dividend angle and the right calls. We thought we could make 50% annualized on it, which for an income fund is pretty good. But I can't tell you that I'm very confident that that dividend is going to be sustained. This is like the piggy bank for Brazil, just to steal it to pay off social expenses. So the risk in this one is a little too high for me.
And then Pato, a long-standing name in natural gas.
Yeah, so you've got a new CEO, same strategy. They just meet, I think they tripled or quadrupled over the dividends, was paying about 8.9% at about a 60% payout ratio. They'll continue to pay down debt as well. If you're bullish on gas and you want income, there's no shortage of names. You could buy this one. New CEOs, maybe it reinvigorates the story. You've got Birchcliff, and in oil, you've got the Cardinals and the Gears and such. So there's a lot. It tells you how much free cash flow is being generated, and how the playbook going forward is low to no growth, maximize free cash flow, and reward investors for their years and years of patience. And my hope is next year that will drive the re-rating from very, very low valuation levels across the board.